Today I want to talk to you about the depreciation trap. Business owners assume that when they finance this equipment, the tax deduction lines up with the loan payments. The assumption makes sense, but in reality, that's where people get caught off guard. You have to remember, depreciation is a tax concept. Loan payments are cash flow reality. Those two things don't often align, or they rarely align. When you finance equipment, you're agreeing to fixed payment schedule. The lender doesn't care how depreciation works. They care that the payment shows up every month on time. Depreciation, on the other hand, follows tax rules. It can be accelerated. It can be reduced. It can be taken all at once. It has nothing to do with your loan terms. That disconnect is the trap. Here's what actually happens. A business owner buys or finances equipment and hears about the tax deduction. Maybe the depreciation will offset the cost in the first year or two. That may feel true. Taxable income is lower. The numbers look better on paper. Everything feels manageable. But the loan doesn't change. The payment is still due every month. And as time passes, the depreciation benefit starts to fade. The deduction gets smaller or disappears entirely while the cash payment continues to be made. This is when cash flow gets tight. So the business is still profitable on paper, but the checking account doesn't reflect that. Owners start wondering why money feels tighter even though revenue hasn't dropped. The issue isn't the revenue, it's the timing. It's especially magnified when depreciation is accelerated. Let me give you an example. You go in, you finance a piece of equipment, you pay 10% down, get a loan for 5 years, 10 years. You deduct it all in that year. In year one, that feels wonderful. But in years 2 through 7 or 2 through 10, that feels horrible. You have cash outlay with no matching depreciation deduction. So accelerated depreciation can create a trap, a cash flow trap that you feel later. Tax benefit shows up early, cash outflow shows up for years. That gap is what surprises people. Another issue I see is when owners assume depreciation equals affordability. Just because something is deductible doesn't mean it's affordable. The tax savings may only cover a portion of the payment, or they might disappear entirely. At that point, the business is carrying the full weight of the payment without the tax cushion. Doesn't mean that financing is a bad decision. It means it needs to be evaluated correctly, especially when you're talking about larger ticket items. So the real question isn't whether depreciation exists. The real question is how depreciation and loan payments interact over time. So before financing equipment, business owners should look at the full picture. How long is the loan? How long does depreciation last? What happens in year 3 or 4 or 5? You need to schedule that capital outlay. Because the biggest mistake I see is planning around the deduction instead of planning around the cash. Taxes matter, but cash keeps the business running. When depreciation runs out before the loan does, the business has to absorb that difference. That's the depreciation trap. Don't just ask what the tax deduction will be this year. Ask what the payment looks like over the life of the loan and how those payments affect cash flow when the tax benefit fades. That conversation should happen before the purchase, not after the purchase. I appreciate you watching. If you found value, please like and give me a comment. Tell me what videos you would like to see. I'd love to make more. Have a great one.